There is a single number that reveals more about the soul of a business than any flashy product launch, any charismatic CEO interview, any headline-grabbing news story. It is a quiet number, often buried deep within financial reports, ignored by the clamor of the daily market. Yet for Warren Buffett, the most successful investor in human history, this one number acts as a secret score, a powerful compass that has consistently pointed him toward companies that create incredible, generational wealth. It's a number that allows an investor to, in less than 30 seconds, separate the true champions of capitalism from the mediocre money pits that masquerade as sound investments. It cuts through the noise, the hype, and the complexity, and lays bare the simple truth of a company's purpose. Is it an efficient engine for turning $1 of its owner's money into more than $1 of real, tangible value? Or is it a sluggish, inefficient machine that slowly grinds capital into dust? The costly mistake that nearly every investor makes, at some point in their journey, is to fall for a good story while ignoring the brutal mathematics of the business itself. They invest in companies that are constantly raising money, constantly diluting shareholders, constantly promising a brighter future that never seems to arrive, all because the fundamental business model is broken. They are inefficient at turning capital into profit. Mastering this one secret score, this one powerful principle of return on equity, prevents that mistake forever. It is the ultimate filter, the first and most important hurdle that any company must clear before it is worthy of your time, your attention, and most importantly, your hard-earned capital. By the end of our journey today, you will possess this filter. You will learn to see the market not as a confusing mess of flashing ticker symbols, but as a collection of businesses, some of which are phenomenal wealth creators and most of which are not. You will have the tool to instantly tell the difference, putting the odds of future success and true financial freedom firmly and permanently in your favor. This isn't just another piece of financial education. This is a fundamental shift in perspective, a new lens through which to view the entire world of business and investing. Our first pillar in understanding this profound concept is what we shall call the ROE compass, discovering true north. The core function of any business, stripped of all its jargon and marketing, is to take capital from its owners, the shareholders, and generate a return on that capital. That's it. That is the game. A business that can take $1 of equity and consistently earn 20 cents on it is a far better business than one that can only earn 5 cents. The number that measures this fundamental efficiency is return on equity, or ROE. It is calculated by taking a company's net income and dividing it by its shareholder equity. It is the truest measure of a business's profitability, telling you exactly how much profit the company generates for every single dollar that the owners have invested in it. To truly grasp why this simple ratio is so powerful, we must travel back in time to 1972, to a decision that would forever alter Warren Buffett's investment philosophy and set the stage for Berkshire Hathaway's astronomical portfolio growth. This isn't a story about high-flying technology or complex financial engineering. It's a story about chocolate. The foundational anecdote that cemented the power of ROE in Buffett's mind was his acquisition of See's Candies. At the time, Buffett was still primarily operating under the framework of his mentor, Benjamin Graham, the father of value investing. This was the cigar butt approach. Find a mediocre company trading for a ridiculously cheap price, get one last free puff out of it, and then sell. It was about buying fair companies at wonderful prices. But Buffett's partner, Charlie Munger, was relentlessly pushing him toward a different, more powerful idea: buying wonderful companies at fair prices. See's Candies was the ultimate test case. On the surface, it seemed unimpressive. It was a regional candy company based in California, selling boxed chocolates. It wasn't a disruptive tech startup. It wasn't a global industrial giant. But when Buffett and Munger looked under the hood, they saw something extraordinary. See's Candies was a financial masterpiece. The business had a beloved brand, a loyal customer base, and something that Buffett would later call an economic moat. Because people associated See's with quality and nostalgia, especially around holidays, the company had tremendous pricing power. It could raise its prices year after year to cover inflation and then some, and customers would barely flinch. They weren't just buying chocolate, they were buying a tradition. This pricing power translated into phenomenal business economics. The company generated about $2 million in after-tax earnings. The crucial part, however, was how much capital was required to generate those earnings. See's had only about $8 million of net tangible assets. This meant its return on tangible equity was a staggering 25%. Think about that. For every dollar of its own capital tied up in the business, in kitchens, in stores, in inventory, it was generating 25 cents in pure profit year after year. The seller, the C family, was asking for $30 million. Buffett's initial reaction, filtered through his Graham-style cigar butt lens, was that the price was too high. It was more than 3 times the company's book value. It didn't look like a statistical bargain, but Munger was insistent. He told Buffett that if he wasn't willing to pay up for a business of this quality, he was going to be stuck buying second-rate companies for the rest of his life. Buffett, to his immense credit, listened. He and Munger ultimately agreed to a price of $25 million. That $25 million investment would become one of the cornerstones of their financial empire. Over the decades that followed, See's Candies would go on to generate more than $2 billion in pre-tax earnings for Berkshire Hathaway, all while requiring very little additional capital investment. It was a gusher of cash. That initial $25 million was returned to them again and again and again, many times over. See's became the prototype, the mental model for what Buffett was now looking for. A business with such a high return on equity that it could fund its own growth and still have enormous amounts of cash left over to send back to its parent company. It taught him that the price you pay is important, but the quality of the business, as measured by its ability to generate high returns on capital, is the true engine of long-term wealth creation. It recalibrated his entire compass. No longer was he just looking for what was cheap, he was now looking for what was truly great. And the needle of that greatness compass was, and remains, a consistently high return on equity. The underlying psychological principle at play here is a powerful cognitive bias that affects nearly all of us, the allure of complexity, and its counterpart, the dismissal of simplicity. In the world of finance and investing, there is a pervasive belief that to be successful, one must engage in something extraordinarily complex. We are bombarded with images of traders staring at a dozen screens filled with esoteric charts, we hear pundits on television debating intricate macroeconomic forecasts, and we read about hedge funds using PhD-level quantitative models to find an edge. This creates a psychological barrier, an expert illusion that convinces the average person that successful investing is beyond their grasp. They believe the secrets to building wealth must be hidden in some arcane formula, or a complex narrative about disruptive technology, or a paradigm-shifting trend. This bias leads investors down rabbit holes, chasing the next big story in biotech, cryptocurrency, or artificial intelligence. They feel that if they can just understand the complex science or the visionary technology, they'll have an advantage. The reality, however, is often the opposite. These complex stories are frequently used to obscure terrible business economics. A company might have a revolutionary product, but if it costs them $1.10 to produce something they sell for $1, the story is irrelevant. They are a capital-destroying machine. The principle of using return on equity as a primary filter is a powerful antidote to this bias. Its power lies in its profound simplicity. ROE doesn't care about the story. It doesn't care how exciting the industry is or how charismatic the CEO is. It asks one simple, brutal question. For every dollar the owners have put into this business, how many cents of profit did the management team generate last year? It is a raw, unvarnished measure of economic reality. By embracing this simple metric, an investor is consciously choosing to override the allure of complexity. They are making a deliberate decision to ignore the siren song of speculative narratives, and instead anchor their analysis in the bedrock of business performance. It's a form of intellectual humility. It's an admission that you don't need to be able to predict the future of genetic engineering to be a successful investor. You just need to be able to identify a business that has demonstrated over a long period a remarkable ability to turn money into more money. Warren Buffett's genius in the See's Candies deal wasn't in forecasting the future of the confectionery industry. It was in recognizing the simple, beautiful math of a business that could earn 25% on its capital in a predictable way. He bypassed the complex and embraced the simple, and it made him billions. This psychological shift is one of the most important an aspiring, intelligent investor can make. To stop seeking complexity as a sign of sophistication and to start appreciating the immense power of simple, robust, and timeless principles. ROE is perhaps the simplest and most powerful of them all. So how do we translate this powerful theory into a practical tool, a blueprint that you can use today to start improving your investment strategy? This is the Applied Mental Model, your step-by-step guide to using ROE as your primary stock screening filter. First, you need to know where to find this number. The good news is, you don't need an expensive data terminal. This crucial piece of information is available for free on dozens of financial websites like Yahoo Finance, Morningstar, or Google Finance. When you look up a stock ticker, you'll typically find a Statistics or Key Ratios tab. Buried in that list of numbers, you will find Return on Equity, TTM, which stands for Trailing 12 Months. That is the company's ROE for the past year, but looking at a single year is not enough. A great business isn't great for just 1 year. It's great for a decade or more. So the second step is to look for consistency. You want to see a company's historical ROE over the last 5 and preferably 10 years. Most of these free websites will have a table or a chart showing this history. What are you looking for? A consistently high number. While there's no single magic number, a good benchmark for a high-quality business is a consistent ROE of over 15%. If you can find a company that has maintained an ROE above 20% for 10 consecutive years, you have likely found a truly exceptional business with a durable competitive advantage. The third step is to understand, in simple terms, what the number represents. Remember the formula, net income divided by shareholder equity. Net income is simply the company's profit after all expenses and taxes have been paid. It's the bottom line. Shareholder equity is also known as book value. It represents the net worth of the company. You can think of it as what would be left over for the owners if the company sold all of its assets and paid off all of its debts. So ROE is simply profit divided by net worth. It is the purest measure of how effectively the management team is using the owner's capital. The fourth and most powerful step is to use this metric for stock screening. Nearly all financial websites have a free stock screener tool. This is where you can filter the entire universe of thousands of publicly traded companies down to a manageable list of potential high-quality candidates. You can set up a simple screen with just a few criteria. 1. Set the market capitalization to be above a certain amount, say $1 billion, to filter out very small speculative companies. 2. And this is the crucial step, set a minimum average ROE over the past 5 years to be, for example, 15%. When you run this screen, you will have instantly eliminated 95% of the market, all the mediocre, capital-intensive, low-return businesses. You will be left with a pre-qualified list of companies that have demonstrated a historical ability to generate excellent returns on their owners' capital. This doesn't mean every company on the list is a great investment at its current price, but it dramatically improves your odds. You are now fishing in a pond stocked with champions. This blueprint transforms you from a passive consumer of market noise into an active hunter of quality, using a simple, powerful tool to guide your search for financial independence. Now, to truly appreciate the wisdom of this path, we must dedicate some time to exploring its opposite, the antithesis, the path of the 99%. This is the path most retail investors travel, and it is a road paved with frustration and financial disappointment. What do? Instead of starting with the simple measure of business quality like ROE, they start with the story, the hype, or the stock price itself. They practice a form of narrative-based investing that is disconnected from the underlying economic engine of the business. The perfect example of this is the airline industry. For decades, investors have been drawn to airlines. It's an industry that feels tangible and important. We see the planes, we use the service, and the companies have household names. The story is compelling. Global travel is always growing, and these companies are the gateways to the world. So people invest. They buy the stock because they believe in the growth of air travel. But had they taken 30 seconds to look at the ROE compass, they would have seen a sea of red flags. Historically, the airline industry has been a financial black hole. It is brutally competitive, with airlines constantly engaging in vicious price wars that destroy profitability. It is incredibly capital-intensive. They have to spend billions of dollars on airplanes that are constantly depreciating. They are subject to the volatile price of fuel, the demands of powerful labor unions, and the whims of economic cycles. The result of this terrible business structure is chronically low, often negative, returns on equity. An airline might need tens of billions of dollars in shareholder equity, invested in its fleet of planes and infrastructure, just to eke out a tiny profit in a good year. In a bad year, they lose billions. Buffett himself famously invested in U.S. Airways in 1989, and, despite making a profit on the investment through a preferred stock structure, he grew to despise the industry's economics. He later quipped that if a capitalist had been present at Kitty Hawk, he should have shot Orville right down, as he would have saved investors a century of misery. The 99% buy the airline stock because they see more people flying. The story. The intelligent investor looks at the decades of single-digit ROE and instantly recognizes it as a terrible business, regardless of the story. The mistake is confusing revenue growth with value creation. An airline can grow its revenues by 10%, but if it has to spend a massive amount of new capital to buy new planes just to achieve that growth, and the return on that new capital is a pitiful 2%, it is actually destroying value for its shareholders. This is the path of the 99%, chasing glamorous stories in industries with rotten economics. Contrast this with the boring story of See's Candies. No disruptive technology, no global domination narrative, just a simple, wonderful business that gushed cash and generated a 25% return on capital. The ROE compass would have steered you away from the exciting but value-destroying airline and pointed you directly toward the boring but wealth-creating chocolate company. Finally, we must trace this principle directly to the numbers on the page and the dollars in your account. What is the direct financial connection between a high ROE and building wealth? It all comes down to the power of retained earnings. When a company earns a profit, it has two choices. It can pay that profit out to shareholders as a dividend, or it can retain the earnings and reinvest them back into the business to fund future growth. Herein lies the magic. A company with a high return on equity is, by definition, a company that is very good at reinvesting capital. Let's imagine two companies, Company A and Company B. Both have a book value or shareholder equity of $100 million. Company A is a wonderful business, like See's Candies, and it has a sustainable ROE of 20%. Company B is a mediocre business, like our hypothetical airline, with a sustainable ROE of 5%. In year one, Company A earns $20 million in profit, 20% of $100 million. Company B earns $5 million, 5% of $100 million. Now let's assume both companies decide to retain all of their profits to grow. At the start of year two, Company A's shareholder equity has grown to $120 million. Because it can still earn 20% on its equity, its earnings in year two will be $24 million, 20% of $120 million. Company B's equity has grown to $105 million. At its 5% ROE, its earnings in year two will only be $5.25 million. The intrinsic value of Company A is compounding at 20% per year, while the value of Company B is only compounding at 5% per year. Over a decade, this difference becomes a chasm. The dollar of retained earnings in the high ROE business created 20 cents of new earning power. The dollar of retained earnings in the low ROE business only created 5 cents. Over time, a company's stock price will inevitably follow its intrinsic value. The high ROE company will see its stock price soar as its earning power and book value explode upwards. The low ROE company's stock will languish. This is the mathematical core of long-term investing. The return you, the shareholder, will ultimately earn on your investment is inextricably linked to the return the business itself earns on its own capital. By focusing on businesses with a demonstrated history of high ROE, you are aligning yourself with the most powerful force in finance, the compounding of capital at a high rate of return. This is how you achieve real portfolio growth. This is how you build lasting wealth and achieve financial freedom. It is not by trading in and out of stocks. It is by owning pieces of exceptional businesses and allowing them to work their compounding magic for you over many years. The ROE compass is the tool that finds those magical businesses. The second great pillar of our exploration is the management litmus test, a framework for separating the true capital alchemists from the corporate charlatans. A company's return on equity is not an abstract number that emerges from a spreadsheet. It is the direct, quantifiable result of thousands of decisions made by the company's leadership. It is the ultimate report card for the chief executive officer and their team. A consistently high ROE is irrefutable evidence of a management that is not only skilled at running the day-to-day operations, but is also, and more critically, brilliant at the art of capital allocation. For Warren Buffett, evaluating the quality of management is paramount, and there is no better story to illustrate this than his relationship with Tom Murphy, the legendary CEO of Capital Cities/Broadcasting. Buffett has repeatedly called Murphy the greatest business manager he has ever met, a statement of profound significance coming from the Oracle of Omaha. Their paths famously intertwined in 1985 in a deal that stunned the media world. The foundational anecdote begins when Tom Murphy and his partner, Dan Burke, decided to do something audacious. Their company, Capital Cities, which was a well-run but modestly sized collection of television stations and newspapers, decided to acquire a company 3 times its size, the American Broadcasting Company, or ABC. It was a minnow swallowing a whale. To finance this massive $17.5 billion acquisition, Murphy needed capital and a partner with a sterling reputation. He turned to his friend, Warren Buffett. Buffett, through Berkshire Hathaway, agreed to invest $517 million in exchange for a stake in the newly combined company. Why was Buffett so willing to make such a concentrated bet on one company and one management team? Because he had been watching Tom Murphy for years. He knew that Murphy was a master of both operational efficiency and capital allocation. He was not a typical empire-building CEO. He was famously frugal, running his corporate headquarters with a skeleton crew. He abhorred corporate waste and bureaucracy. But his true genius lay in how he thought about capital. Murphy and Burke treated their shareholders' money as if it were their own. They only made acquisitions if they were absolutely certain the returns would be high. They aggressively bought back their own stock when it was cheap, recognizing that the best investment they could often make was in their own fantastically run business. This discipline was reflected in their financial results. For decades, Capital Cities had produced staggering returns on equity. Buffett wasn't just investing in a portfolio of media assets. He was investing in the brain of Tom Murphy. He knew that Murphy would take the assets of the larger, more bloated ABC and run them with the same ruthless efficiency and capital discipline that had made Capital Cities so successful. And that is exactly what happened. Murphy and Burke slashed costs, sold underperforming assets, and focused on maximizing the profitability of their core television network and stations like ESPN. The result was a dramatic increase in the combined company's profitability and, consequently, its return on equity. The $517 million investment became a multi-billion-dollar windfall for Berkshire Hathaway. The story of Tom Murphy and Capital Cities teaches us a vital lesson. A high ROE over a long period is the clearest sign you can find of a shareholder-oriented, rational, and talented management team. It is the number that proves the CEO is not just a charismatic visionary, but a true steward of your capital. The psychological principle that this focus on ROE helps us overcome is a combination of two powerful biases, the halo effect and the agency problem. The halo effect is our tendency to let one positive trait of a person or thing color our judgment of their other traits. In the world of business, this is rampant. A CEO might be a brilliant public speaker, a visionary product designer, or a media darling. We see this one positive trait, their charisma, or their visionary status, and we automatically assume they must also be brilliant financial managers and capital allocators. We put a halo on them. Think of the celebrity CEOs who grace the covers of magazines. Investors fall in love with their personality and their story, and they stop scrutinizing the numbers. They believe the hype, assuming that such a brilliant individual must be creating shareholder value. But the skills that make a great innovator or a great salesperson are often entirely different from the skills that make a great capital allocator. A visionary CEO might be fantastic at growing revenues, but terrible at turning that growth into profit for the owners. They might be prone to empire building, pursuing expensive, ego-driven acquisitions that destroy shareholder value, all while being cheered on by a fawning media. This is where the agency problem comes in. In any large corporation, the managers, the agents, are supposed to act in the best interests of the owners, the principals, or shareholders. However, their interests are often not aligned. The CEO's compensation might be tied to the size of the company or its revenue growth, not its profitability or return on equity. This incentivizes them to grow the empire at any cost, even if it means making acquisitions that dilute existing shareholders and produce terrible returns. They might prefer to keep a mountain of cash on the balance sheet earning a pittance, rather than returning it to shareholders because it gives them more power and prestige. ROE acts as a powerful truth serum against both of these biases. It cuts through the halo of a CEO's charisma and directly measures their performance on the metric that matters most to owners: profitability. It helps solve the agency problem by giving shareholders a clear, objective tool to judge whether management is truly working for them. A long track record of high ROE is evidence of alignment. It proves that management isn't just growing an empire for its own sake. It is building a more valuable and more profitable business for its owners. By focusing on this number, the intelligent investor insulates themselves from the seductive but often misleading narratives spun by charismatic leaders and the financial media. How can you, as an investor, put this into practice? You can use an applied mental model we'll call the Management Quality Checklist, using ROE as your guide. First, when you analyze a company, don't just look at the current ROE, look at the trend over the past decade. Is the ROE stable and high, which suggests a durable business and consistent management? Is it rising, which could indicate a positive turnaround or an improving competitive position? Or is it falling, which is a major red flag that could signal deteriorating business economics or, crucially, a series of poor capital allocation decisions by a new management team? A track record is everything. Second, your next step is to go beyond the numbers and read the CEO's annual letter to shareholders. This is one of the most underutilized tools in all of investing. In this letter, you get a direct window into the mind of the person running the company. What do they talk about? A great shareholder-oriented CEO like Buffett or Tom Murphy will talk incessantly about returns on capital, about return on equity, about managing the business from an owner's perspective. A less shareholder-friendly CEO will fill their letter with corporate jargon, vague buzzwords like synergy and transformation, and will often highlight misleading adjusted earnings figures that paint a rosier picture than reality. The language they use is a powerful tell. If a CEO isn't talking about the key drivers of long-term value, it's likely they aren't focused on them. Third, you must scrutinize their specific capital allocation decisions over the past 5 years. Where did the company's cash go? Did they make a series of large acquisitions? If so, go and look at what they bought and what they paid. Did those acquisitions actually improve the company's overall ROE, or did they dilute it? This is called a diversification. Did they pour billions into capital expenditures? If so, has that spending led to a proportional increase in profits? Or did they systematically buy back their own shares? Buying back shares can be a wonderfully tax-efficient way to return capital to shareholders, but only if the stock is purchased at a reasonable price. A management team that buys back billions of dollars of its own stock at peak valuations is just as destructive as one that makes a terrible acquisition. Finally, compare the company's ROE to its direct competitors. Is this company the leader of the pack, or is it a laggard? A company that consistently generates a higher ROE than its peers almost certainly has a better management team or a structural advantage. This checklist transforms ROE from a static number into a dynamic tool for a deep, qualitative assessment of the people in charge of your money. To fully internalize this lesson, let's examine the antithesis, the path of the 99% when it comes to evaluating management. The most common mistake is to blindly follow celebrity CEOs, especially those who preside over exciting, fast-growing companies. The herd mentality takes over, and critical analysis is abandoned. The most catastrophic example of this in corporate history is the AOL-Time Warner merger in the year 2000. At the peak of the dot-com bubble, America Online, the high-flying internet darling, led by the charismatic Steve Case, acquired Time Warner, the old media behemoth. The deal was hailed by Wall Street and the media as a visionary masterpiece, a marriage of new media and old content that would create an unassailable global giant. Steve Case and Time Warner's CEO, Gerald Levin, were lauded as geniuses. Investors poured into the stock, believing in the story and in the celebrity leaders who were telling it. They didn't stop to do the math. They didn't stop to ask what the return on a combined $164 billion of equity would look like. The reality was a financial disaster of epic proportions. The promised synergies never materialized. The cultures of the two companies clashed horribly. The internet bubble burst, and AOL's business model, which was heavily reliant on dial-up subscriptions, began to crumble in the face of broadband. The combined company was saddled with enormous debt and assets that were declining in value. The result was a record-breaking $99 billion loss in 2002. The stock price collapsed, wiping out hundreds of billions of dollars in shareholder wealth. It is now widely regarded as the worst merger in corporate history. Where did the 99% go wrong? They fell for the halo effect hook, line, and sinker. They were mesmerized by Steve Case and the new economy narrative. They ignored the astronomical price being paid and the monumental task of integrating two vastly different corporate beasts. An investor focused on ROE would have been deeply skeptical. They would have seen AOL, a company with a high ROE but a frothy valuation and a business model under threat, acquiring Time Warner, a massive, complex, and mediocre return business. They would have calculated that the combined entity would almost certainly have a much lower return on equity than AOL had on its own. The sheer amount of goodwill and intangible assets created in the merger would have bloated the equity base, making high returns mathematically almost impossible. By focusing on the story and the celebrity CEOs, investors walked willingly into a value-destroying inferno. By focusing on the cold, hard math of ROE, an intelligent investor would have stayed a million miles away. So let's bring this down to the financial statements and see the direct connection. How does a great management team's focus on ROE manifest on the balance sheet and income statement, and how does that translate into wealth for you, the shareholder? It shows up in three key areas: capital structure, operational efficiency, and reinvestment decisions. First, capital structure. A great manager uses debt intelligently. They don't avoid it entirely, but they don't take on excessive leverage that could jeopardize the company in a downturn. They understand that debt can amplify returns on equity, this is called financial leverage, but only if the business is stable and predictable. A management team that takes on a mountain of debt to finance a risky acquisition is not shareholder-focused. They are gambling with your equity. A high and stable ROE is often a sign of a prudent capital structure. Second, operational efficiency. This is visible all over the income statement. A management team focused on returns will relentlessly manage costs. They will keep a close eye on their profit margins, gross margin, operating margin, and net margin. They will efficiently manage their working capital, ensuring they aren't tying up too much cash in inventory or accounts receivable. Every dollar they save through efficiency drops straight to the bottom line, net income, which in turn boosts the numerator in the ROE calculation, directly increasing the return on equity. Tom Murphy was the master of this. His legendary frugality was not about being cheap, it was about being efficient to maximize shareholder returns. Third, and most importantly, is their reinvestment decision-making. This is the heart of capital allocation. When a company generates cash, a great management team will weigh their options with a clear-eyed focus on maximizing value. Can they reinvest that dollar back into the business in a project that will earn a return higher than their current ROE? If so, they do it. This might mean opening new stores, building a new factory, or investing in research and development. But they will only do so if the expected returns are excellent. If they can't find high-return projects internally, they will consider an acquisition. But again, only if the price is right and the target company will improve their overall profitability. If there are no good internal or external investment opportunities, a great manager will make the most shareholder-friendly decision of all. They will return the capital to the owners, either through dividends or, preferably, through share buybacks when the stock is undervalued. This disciplined process ensures that every dollar of capital the company controls is being put to its highest and best use. This relentless focus on the denominator of the ROE equation, the equity base, is the hallmark of a CEO with the right mindset. They treat your money as a scarce and precious resource, which in turn leads to a rising book value per share and, ultimately, the massive capital gains that create true financial independence. This brings us to our third, and perhaps most exciting pillar, the compounding engine, or how a high return on equity fuels the incredible wealth-creating snowball effect. Albert Einstein is often apocryphally credited with calling compound interest the eighth wonder of the world. While he probably never said it, the sentiment is profoundly true. Compounding is the silent, invisible force that can turn modest sums of money into fortunes over time. In investing, the most powerful way to harness this force is to own businesses that are themselves compounding machines. And the engine of that compounding machine, the component that determines its speed and power, is its return on equity. The perfect foundational anecdote to understand this concept is Warren Buffett's single greatest investment, his purchase of a massive stake in the Coca-Cola Company in 1988. This was a defining moment for Buffett, a move that fully solidified his transition from a buyer of cheap companies to an owner of wonderful, world-class enterprises. In the late 1980s, after the stock market crash of 1987, Buffett saw an opportunity. Coca-Cola, the global beverage behemoth, was trading at a reasonable price. But what Buffett saw was not just a fair price. He saw one of the most perfect business models ever created. Coca-Cola was the quintessential capital-light compounder. Think about its business. The company itself did not own a vast, expensive network of bottling plants. It sold syrup concentrate, a secret formula, to a network of independent bottlers all over the world. This meant that Coca-Cola could grow its global sales dramatically without having to invest billions of dollars in new factories and equipment. Its primary assets were not physical. They were intangible. The most valuable thing it owned was the brand name Coca-Cola, a symbol of happiness and refreshment recognized in every corner of the globe. This powerful brand gave it immense pricing power. It could slowly raise the price of its syrup concentrate year after year, and the bottlers and consumers would pay it. The result of this capital-light model and strong brand was a truly spectacular return on equity. Coca-Cola was consistently generating an ROE of over 30%. It was a money-printing machine. Buffett invested over $1 billion, acquiring a significant portion of the company. He saw that Coca-Cola was earning these incredible returns and still had a long runway for international growth. It could retain a portion of its massive profits and reinvest them in marketing and global expansion, and those reinvested dollars would, in turn, earn the same 30% return. This created a virtuous cycle, a self-perpetuating engine of value creation. $1 of retained earnings at Coca-Cola wasn't just $1, it was a magic seed that would sprout into 30 cents of new profit the following year, which would then be reinvested to generate even more profit. This is the compounding engine in action. The high ROE was the fuel. Buffett's investment in Coca-Cola became a cornerstone of Berkshire Hathaway's portfolio, increasing in value more than tenfold over the following decade, and gushing billions in dividends. It was the ultimate proof that the highest long-term returns don't come from trading in and out of stocks, but from owning a piece of a superior business and letting its internal compounding engine do the heavy lifting for you. The psychological principle that this understanding helps us conquer is one of the most deeply ingrained and destructive human biases: hyperbolic discounting. This is a fancy term for a simple concept. We human beings are wired to strongly prefer a smaller, immediate reward over a larger, delayed reward. It's the reason why so many people struggle to save for retirement, choosing the immediate pleasure of spending today over the much larger financial security of tomorrow. It's why diets are so hard to stick with. The immediate reward of a donut is more compelling than the distant reward of better health. In investing, hyperbolic discounting manifests as an obsession with short-term performance. Investors check their portfolios daily, get excited by a stock that jumps 10% in a week, and get panicked by one that drops. They are constantly looking for the next hot tip, the next trade, that will give them that immediate gratification of a quick profit. This short-term focus makes them blind to the far greater, more powerful force of long-term compounding. Internalizing the link between ROE and the compounding engine is a cognitive therapy for this bias. It helps you rewire your brain to appreciate the delayed, but exponentially larger, reward. When you understand that a company with a 30% ROE is capable of growing its intrinsic value at an astonishing rate over a decade, the small-scale drama of the daily stock market fluctuations begins to seem trivial. You are no longer focused on the stock price. You are focused on the value creation machine you own. It provides the intellectual framework needed for patience, which is the rarest and most valuable commodity in the market. It allows you to endure the inevitable periods of market volatility, not with fear, but with conviction, because you know the underlying business is still chugging along, reinvesting its earnings at a high rate. It helps you make the shift from a gambler seeking a quick hit to a true business owner cultivating a long-term asset. Overcoming hyperbolic discounting is a crucial step towards becoming an intelligent investor, and the concept of the ROE-fueled compounding engine is the key that unlocks that mental door. So how can we turn this into a practical, applied mental model? Let's build what we can call the compounding test for any potential investment. This test helps you quantify the power of compounding and shift your mindset from short-term speculation to long-term value creation. Step 1 is to calculate a company's sustainable growth rate. The formula for this is simple: ROE multiplied by the company's retention ratio. The retention ratio is simply 1 minus the dividend payout ratio. For example, if a company has an ROE of 20%, and it pays out 40% of its earnings as dividends, its retention ratio is 60%. Its sustainable growth rate would be 20% multiplied by 60%, which equals 12%. This number is incredibly important. It represents the theoretical rate at which the company can grow its earnings and book value per year without having to issue new stock or take on more debt. It is the speed of its internal compounding engine. Step 2 is to use this rate to project the growth in the company's book value per share over the next 10 years. You can create a simple spreadsheet. Start with today's book value per share and grow it by the sustainable growth rate year after year for a decade. This simple exercise makes the abstract concept of compounding tangible. You can physically see how a company with a high sustainable growth rate can double or triple its intrinsic value over a decade, purely through the power of reinvesting its own profits. Step 3 is to ask the crucial qualitative question: is this sustainable? The calculation is just a starting point. You must think critically about whether the company can realistically continue to reinvest its capital at these high rates of return. Does it have a long runway for growth? Is it operating in a growing industry? Does it have a durable competitive advantage that will protect its profitability? A company might have a high ROE today, but if it has saturated its market and has no place to profitably reinvest its earnings, its compounding power will soon fade. The final step of this mental model is to reframe your entire investment inquiry. Instead of asking, "What will the stock do this quarter?" you now ask, "How much business value will this company create over the next decade?" This simple shift in perspective, driven by the mathematics of the compounding test, aligns you with the mindset of the world's greatest long-term investors and sets you on the path to massive portfolio growth. The antithesis to this approach, the path followed by the 99%, is to fall into what is known as the dividend trap. Many novice investors, particularly those seeking income, become fixated on a stock's dividend yield. They will screen for companies paying high yields, 5, 6, or even 7%, believing they have found a safe and profitable investment. On the surface, it seems logical. The company is sending you a check every quarter. What could be wrong with that? The problem is that a high dividend yield, in isolation, tells you nothing about the quality or the growth prospects of the underlying business. In fact, a very high dividend yield can often be a major red flag. It can be a sign of a company in deep trouble, where the stock price has fallen so far that the yield looks artificially high right before the company is forced to cut the dividend. More commonly, however, the dividend trap snares investors in stagnant, low-growth businesses. Consider a typical utility company. It might have a stable, regulated business and pay out a handsome 5% dividend. The investor who buys it is happy with their income, but what they often fail to investigate is the company's ROE. A mature utility company might only be earning an ROE of, say, 8%. Because it is paying out most of its earnings as dividends, it might only retain enough capital to grow its business at 2 or 3% per year. The investor gets their 5% income, but the underlying intrinsic value of the business is barely growing faster than inflation. They are getting income, but they are missing out on the far more powerful force of capital appreciation. They have traded the explosive potential of compounding for the comfort of a steady check. Compare this to our high ROE company. It might pay a smaller dividend or no dividend at all, but by reinvesting its capital at 20% per year, it is creating far more value for its shareholders over the long run. The 99% chase the yield. The intelligent investor looks for the compounding engine. The dividend is what the company gives you. The retained earnings, when reinvested at a high rate of return, are what the company builds for you. One provides a trickle of cash, the other builds a mountain of wealth. The direct financial connection here is the mathematical heart of the entire video thesis. Let's make this crystal clear with a direct numerical comparison. Imagine you have $10,000 to invest for 10 years. You have two choices. Company A is our high-quality compounder with a consistent 25% ROE. It retains all of its earnings to grow. Company B is our stagnant dividend payer with an 8% ROE. It pays out half of its earnings as dividends and retains the other half, giving it a sustainable growth rate of 4%. Let's assume you buy both companies at their book value. Your $10,000 investment in Company A starts with a book value of $10,000. After 1 year, the company earns 25%, so its book value grows to $12,500. The next year, it earns 25% on that new higher base, growing to over $15,600. After 10 years of compounding at 25%, the book value of your initial investment will have grown to over $93,000. Your stake in the business is now worth more than 9 times what you paid for it. Now let's look at Company B. Your $10,000 investment has a book value of $10,000. In the first year, it earns 8% or $800. It pays out $400 in dividends and retains $400. So at the start of year 2, the book value of your stake is $10,400. After 10 years of growing its book value at 4% per year, it will be worth just under $15,000. You will have also collected a stream of dividends along the way, but even if you reinvested every single dividend, your total return would be dwarfed by the explosive growth of Company A. This is the raw power of ROE. The difference between a 25% return on equity and an 8% return on equity, when compounded over a decade, is not a small difference. It is the difference between creating significant wealth and barely keeping pace with inflation. This is how a sound investment strategy translates directly into building wealth and achieving financial freedom. It is not about timing the market or finding the next hot stock. It is about finding a business that is a superior compounding machine and then letting it run for a very, very long time. Our fourth pillar is the moat detector, which explains why a long history of high return on equity is the most reliable signal you can find that a company is protected by a deep and durable competitive advantage, or what Buffett famously calls an economic moat. Capitalism is a paradox. It is the greatest system ever devised for creating wealth, but it is also brutally competitive. The moment a company starts making unusually high profits, it is like blood in the water for sharks. Competitors will swarm in, imitating its products, undercutting its prices, and trying to steal its customers. In a truly competitive, commodity-like industry, this process is relentless. It drives down the returns for all participants to a mediocre level, just enough to stay in business. Therefore, if you find a company that has managed to sustain a very high return on equity, say north of 20%, for 10, 15, or even 20 years, you have found something special. You have found a company that has a powerful defense system, a moat, that keeps those competitors at bay. A high ROE is the effect. The economic moat is the cause. The foundational anecdote that perfectly illustrates this connection is Buffett's long-standing investment in Moody's Corporation, the credit rating agency. On the surface, Moody's business seems simple. It analyzes the creditworthiness of companies and governments that issue bonds and assigns them a rating, like AAA or B-. For this service, it gets paid a fee. But the financial characteristics of this business are nothing short of breathtaking. Moody's requires almost no tangible capital to operate. Its main assets are its reputation, its analytical models, and the trust of the market. It doesn't need factories, it doesn't need inventory, it doesn't need a huge physical infrastructure. As a result, its return on tangible equity is astronomical, often running into the hundreds of %. It is a cash-generating machine of the highest order. But why can it earn such incredible returns? Why haven't dozens of competitors emerged to drive down its prices and profits? The answer is its massive, almost impenetrable economic moat. The moat around Moody's is built on several powerful factors. First, it operates in a duopoly. Along with Standard & Poor's, it controls the vast majority of the global credit rating market. Any company that wants to issue bonds and have them taken seriously by investors effectively must get a rating from one of these two firms. This gives them incredible pricing power. Second, it benefits from a massive regulatory moat. Financial regulations around the world often explicitly require certain types of bonds to have a rating from a recognized agency, effectively enshrining Moody's position in the financial ecosystem. It would be incredibly difficult for a new competitor to gain this same level of regulatory acceptance. Third, and most importantly, is the moat built on reputation and trust. Established over a century, an investor buying $1 billion worth of bonds needs to trust the rating. They are not going to trust Bob's new ratings agency, even if Bob charges a lower price. The risk of getting it wrong is too high. This combination of duopolistic market structure, regulatory protection, and deep-seated trust creates a fortress around Moody's business, allowing it to earn its spectacular returns, year after year, decade after decade, without fear of significant competition. The consistently sky-high ROE is not an accident. It is the direct financial manifestation of its unbreachable economic moat. The underlying psychological principle at work here is a pervasive cognitive error known as competition neglect. When entrepreneurs or investors analyze a business opportunity, They have a natural tendency to focus on the attractive aspects of the market, its size, its growth rate, the quality of the product, while systematically underestimating the power and intensity of future competition. They fall in love with their own idea or their own investment thesis, and fail to ask the most important question in capitalism: what will stop someone else from coming along and doing the same thing, but cheaper? This is a form of optimism bias. We assume that the wonderful profitability we see today will persist into the future, forgetting that high profits are a powerful magnet for rivals. A restaurant that opens and has a fantastic first year, earning a high return on its initial investment, will soon find 3 new competing restaurants opening up on the same block. Within a couple of years, the intense competition will have driven down prices and driven up costs, and the once high returns will have vanished. Using a long history of high ROE as a screening tool is the perfect antidote to competition neglect. It forces the investor to confront this issue head-on. A company cannot maintain a 25% ROE for 10 years by accident. It can only do so if it has some kind of structural advantage, some moat, that protects it from the erosive forces of competition. By starting your analysis with a screen for companies with a proven track record of high returns, you are biasing your search toward businesses that have already demonstrated their competitive resilience. You are deliberately filtering out the thousands of one-hit wonder companies and the businesses that operate in brutally competitive commodity-like industries. It trains your mind to stop looking for what's hot and start looking for what's durable. The psychological shift is from "this is a great product" to "this is a great business." A great product can be copied. A great business, protected by a deep moat, can endure for generations. Let's translate this into an applied mental model, the moat identification framework, using ROE as your starting point. Step 1 is to run your screen. Filter the market for companies that have maintained a consistently high ROE, say above 20%, for at least the last 10 years. This gives you your hunting ground, your list of potential fortress businesses. Step 2 is, for each company on that list, to play detective. Your job is to identify the specific source of that durable profitability. Why have the competitors been kept at bay? Generally, economic moats come in 4 main varieties. First, intangible assets. This could be a powerful brand name, like Coca-Cola's, that commands customer loyalty and pricing power. It could be a portfolio of patents that protects a pharmaceutical company's blockbuster drug. Or it could be a regulatory license, like Moody's, that is required to operate in a certain industry. The second type of moat is high switching costs. This exists when customers are locked into a company's product or service, because the cost, time, or hassle of switching to a competitor is too great. Think about the bank where you have your checking account or the enterprise software that your company uses to run its operations. The service might not be perfect, but the pain of switching is so high that you stick with it. This gives the company pricing power and very stable, recurring revenue. The third type of moat is the network effect. This is when a product or service becomes more valuable to each user as more people use it. Credit cards like Visa and American Express are a classic example. The more merchants that accept the card, the more valuable it is to cardholders. And the more cardholders there are, the more essential it is for merchants to accept it. This creates a powerful, self-reinforcing feedback loop that locks out new competitors. The fourth moat is a cost advantage. This can come from superior scale, like Costco, which can buy goods in such massive quantities that it can sell them cheaper than anyone else. Or it can come from a unique process or location that allows a company to produce its goods or services at a lower cost than its rivals. This framework is a powerful tool. It takes the quantitative signal of high ROE and forces you to do the qualitative work of understanding the why behind it, leading you to a deeper understanding of the business's long-term durability. To fully appreciate this framework, let's explore the antithesis, the path of the 99%, which is to chase fads and invest in moatless growth. This is an incredibly common and costly mistake. An investor sees a company whose revenues are growing rapidly and gets excited. They buy the stock, projecting that growth far into the future, without stopping to ask if the company's profits are protected. A perfect example would be a company in a hot new industry, like, for a time, solar panel manufacturing or 3D printing. When these technologies were new and exciting, dozens of companies rushed into the space. For a brief period, the early movers might have earned high returns. Investors who chased the hype and bought the stocks saw them soar. But what happened next was inevitable. The technology was not proprietary. Anyone could build a factory to make solar panels. The barrier to entry was low. Dozens, then hundreds of competitors, especially from low-cost manufacturing countries, flooded the market. The result was a massive glut of supply, a collapse in prices, and a sea of bankruptcies. The profits and the high ROEs vanished almost overnight. The 99% invested in the exciting story of green energy or the future of manufacturing. They didn't stop to analyze the industry structure. They didn't see that there was no moat. There were no strong brands, no switching costs, no network effects. It was a commodity business, plain and simple. An investor using the moat detection framework would have been highly skeptical. They might have seen a company with 1 or 2 years of high ROE, but they would have recognized that this was likely a temporary phenomenon. They would have looked for the protective barrier, and finding none would have stayed away. This is the difference between investing in a trend and investing in a durable business. Trends come and go. Moats can last for a century. The path of the 99% is to chase the former and be repeatedly burned. The path of the intelligent investor is to patiently search for the latter and be rewarded with a lifetime of compounding wealth. The direct financial connection between a moat and your portfolio is profound and multifaceted. It goes beyond just the high ROE itself. A strong and durable economic moat leads to a quality of earnings that is far superior to that of a moatless company. The cash flows of a company like Moody's or Coca-Cola are incredibly predictable and reliable. This predictability is highly valued by the market. Financial analysts can forecast their future earnings with a much higher degree of confidence, which in turn reduces the perceived risk of the investment. This lower risk and higher predictability directly translate into a higher valuation multiple that the market is willing to pay for the company's stock. For example, a protected high ROE business might consistently trade at a price-to-earnings, or PE, ratio of 25. A cyclical, moatless, low ROE business in a competitive industry might only trade at a PE ratio of 10. This means that for every dollar of earnings the moated business generates, the market assigns 2.5 times more value to it. This quality premium provides a double-barreled benefit to the long-term investor. Not only are the earnings themselves growing at a high rate due to the high ROE, but each of those dollars of earnings is also valued more highly by the market. This is a powerful combination that leads to explosive capital gains. Furthermore, a moat provides downside protection during economic downturns. When a recession hits, the weak, moatless companies are often the first to suffer. Their customers flee to lower-priced alternatives, their profits evaporate, and some may even go bankrupt. The fortress-like business, however, with its loyal customers, its pricing power, and its strong financial position, can often sail through the storm with minimal damage. Some, like a low-cost leader, may even strengthen their competitive position during a recession. This resilience makes for a much smoother and less stressful ownership experience and protects your capital from permanent loss. In essence, a moat is a financial shock absorber. It ensures that the compounding engine doesn't just run fast in the good times, but that it also keeps running during the inevitable bad times, safeguarding your journey towards financial independence. We have arrived at our fifth and final pillar, the price anchor, which teaches us how to use return on equity to ground our valuation and avoid the single most common mistake made by investors in high-quality companies: overpaying. Discovering a wonderful business with a high and sustainable ROE is a monumental step, but it is only half the battle. The final crucial piece of the puzzle is to buy that wonderful business at a fair price. Even the best company in the world can be a terrible investment if you pay too much for it. The principle of ROE, when combined with a company's market price, can provide a powerful anchor of rationality, preventing you from getting swept away by market euphoria and ensuring your investment strategy leads to real, tangible capital gains. The perfect foundational anecdote for this lesson is one of Warren Buffett's earliest and most brilliant investments, his purchase of a large stake in the Washington Post Company in the early 1970s. In 1973, the stock market was in the midst of a brutal bear market. Sentiment was terrible, investors were panicked. The Washington Post Company, despite being a high-quality media enterprise, saw its stock price get hammered, along with everything else. Its market capitalization fell to just $80 million. Buffett, a voracious reader of newspapers and a keen student of business, saw an opportunity of a lifetime. He knew the Washington Post was not just any newspaper. In its home market of Washington, D.C., it had a virtual monopoly. It was the dominant source of news, opinion, and advertising. This gave it a powerful local moat and significant pricing power. It was a wonderful business, consistently earning a healthy return on its equity. But the market, in its fit of pessimism, was ignoring this quality. Buffett did a quick, back-of-the-envelope calculation. He estimated that the company's assets, its newspaper, its television stations, and its other properties, could be sold off individually for at least $400 million, maybe even $500 million. And yet, the stock market was offering him the chance to buy the entire company for $80 million. He was being offered $1 of prime business assets for 20 cents. It was an unbelievable bargain. He began buying the stock aggressively, investing over $10 million, which at the time was a huge sum for him. The board of the Post, led by the formidable Katharine Graham, was initially suspicious of this outsider from Omaha buying up their stock. But Buffett persisted, explaining that he was a long-term, passive investor who simply recognized the immense value of their business. He eventually won their trust and was invited to join the board. His $10 million investment would eventually grow to be worth over $1 billion. The Washington Post's story is the perfect synthesis of the Buffett philosophy. First, he identified a wonderful business, protected by a deep economic moat that generated high returns on capital. Second, and just as importantly, he waited patiently for the market to offer him that business at a ridiculously cheap price. He used the market's manic-depressive mood to his advantage. He didn't just buy quality, he bought quality at a deep discount. This discipline of anchoring your purchase price to the underlying value of the business, a value largely determined by its long-term return-generating power, is the final step to becoming a truly intelligent investor. The psychological trap that this price discipline helps us avoid is the powerful and dangerous anchoring bias. This bias describes our tendency to rely too heavily on the first piece of information we receive, the anchor, when making decisions. In investing, this manifests in several ways. An investor might see that a stock's price was once $200 a share. It has now fallen to $100. They anchor on the old price of $200 and conclude that the stock must be cheap at $100. They buy it without doing any fundamental analysis of whether the business is actually worth $100 a share. The previous price is completely irrelevant, but it acts as a powerful psychological anchor. More dangerously, anchoring bias affects how we view popular, high-quality companies. An investor might correctly identify a fantastic company, say a tech giant, with a strong moat and a high ROE. They fall in love with the business and its story. The stock price keeps going up. They become anchored to the narrative of greatness and start to believe that the company is a good buy at any price. They chase the stock higher and higher, paying a valuation that is completely disconnected from its underlying earning power. ROE provides a rational, mathematical anchor to combat this emotional bias. It forces you to ask a different, more intelligent question. Instead of asking, "Is the stock price going up?" you are forced to ask, "Given the price I have to pay today, what is the return I am likely to get on my capital?" It shifts your focus from the ephemeral sentiment of the market to the durable economics of the business. By comparing the price you pay to the company's demonstrated ability to generate returns, its ROE, You are grounding your decision in business reality, not market fancy. It creates a valuation discipline that prevents you from joining the herd and buying a wonderful company at a terrible price. It is the voice of reason that whispers, yes, it's a great business, but not at this price. Learning to listen to that voice is the difference between a successful investor and a speculator who gets caught up in bubbles. How can we create an applied mental model for this, a practical framework to connect ROE to a rational purchase price? Let's call it the ROE to price valuation check. It's a simple two-step process to get a quick sense of whether a stock is in a reasonable valuation territory. Step 1 is to determine the company's normalized long-term return on equity. Don't just use last year's number. Look at the average ROE over the past 5 or 10 years to get a sense of its sustainable, through-the-cycle profitability. Let's say you determine a company's sustainable ROE is a healthy 20%. This is the return the business itself earns on its owners' capital. Step 2 is to calculate what your personal return will be in the first year if you buy the stock today. This is called the earnings yield. The formula is simply the company's earnings per share, EPS, divided by its current stock price. It's the inverse of the more famous P/E ratio. For example, if a company has earnings per share of $5 and its stock price is $100, its earnings yield is 5%, 5 divided by 100. Now, you compare the two numbers. The business is earning 20% on its internal capital, but at the current price, your initial yield as a new owner is only 5%. This immediately tells you that you are paying a significant premium for this quality business. This doesn't automatically mean it's a bad investment. If the company can continue to reinvest its earnings at that high 20% rate, your returns will still be quite good over the long run. However, it gives you a crucial anchor. You know you are not buying it at a bargain. Now, imagine another scenario. The same company, with its 20% ROE, sees its stock price fall to $50 during a market panic. Its earnings per share are still $5. Now, its earnings yield is 10%, 5 divided by 50. This is a much more attractive proposition. You are buying a 20% business at a price that gives you a 10% initial yield. This is the kind of opportunity that gets value investors excited. A more advanced way to think about this is by using the price-to-book P/B ratio. There's a simple mathematical identity. A company's ROE is equal to its P/E ratio divided by its P/B ratio. This shows that a company with a high ROE can justify a higher P/B ratio. This framework doesn't give you a precise intrinsic value, but it is an incredibly powerful tool for imposing price discipline and ensuring you don't overpay for quality. The antithesis, the path of the 99%, is to commit the sin of paying for growth and quality at any price. The greatest historical lesson on this folly is the Nifty 50 era of the early 1970s and, more recently, the dot-com bubble of the late 1990s. In both periods, the market became convinced that a certain group of companies was so good, so dominant, and had such bright growth prospects that their stock was a good buy at any valuation. The Nifty 50 included blue-chip stalwarts like Polaroid, Xerox, and Coca-Cola. Investors believed you could buy them and never sell them, regardless of the price. They bid the P/E ratios of these companies up to 50, 60, even 100. They were paying prices that implied decades of flawless, uninterrupted, high-speed growth. When the brutal bear market of 1973-74 arrived, these stocks collapsed, falling 50, 60, even 80%. It took many of them over a decade just to get back to their previous highs. The companies themselves were still good businesses, but the prices paid were so astronomical that the investments were a disaster. The dot-com bubble was an even more extreme version of this madness. Investors were buying companies that had no earnings at all, and therefore had a negative return on equity. They completely abandoned all traditional valuation metrics, arguing that this time is different. They were buying stories, eyeballs, and clicks, not profitable businesses. They paid prices that were not just unanchored from reality, they were in a different galaxy. When the bubble burst, trillions of dollars of speculative wealth were vaporized. In both cases, the 99% abandoned the principle of a price anchor. They were swept up in the euphoria and the narrative, and they paid a terrible price for it. An investor grounded in the ROE to price framework would have seen the insanity. They would have calculated the earnings yields of the Nifty 50 stocks and found them to be pitifully low, 1 or 2%. They would have looked at the dot-com stocks and seen negative ROE, an immediate disqualifier. This discipline would have saved them from catastrophic losses, preserving their capital to be deployed when prices inevitably returned to sane levels. Let's make the direct financial connection that ties all of this together. The ultimate goal of investing is to earn a high rate of return on your own invested capital. Your personal return as an investor is a function of two things: the underlying performance of the business and the price you pay to own a piece of that business. By insisting on buying a high ROE company at a reasonable price, you are aligning these two forces in your favor. Let's revisit our 20% ROE company. If you are able to buy it at a price that gives you an 8% earnings yield, a PE of 12.5, you have a powerful combination. The company can reinvest its retained earnings and grow its intrinsic value at a very high rate, and you bought into that growth stream at an attractive price. Your future returns are likely to be spectacular, composed of both the growth in the company's earnings and a potential expansion of the valuation multiple, as other investors recognize the quality you found at a bargain price. Now, let's say you buy that same 20% ROE company during a period of market euphoria, and you pay a price that gives you only a 2% earnings yield, a PE of 50. Your future returns are now severely handicapped. The business itself is still great, but you have paid so much for it up front that a huge portion of the next decade's growth is already priced in. For you to earn a decent return, the company not only has to perform perfectly, but it also has to grow even faster than the market's already sky-high expectations. Your margin of safety is gone. The slightest misstep by the company could lead to a sharp fall in the stock price as the high valuation multiple contracts. This is how you can own a great company and still get a terrible investment return. The final secret is this: Warren Buffett's genius is not just in identifying wonderful businesses, it is in his ironclad discipline to only buy them when the price makes sense. The ROE compass points you to the quality business. The price anchor tells you when to pull the trigger. Mastering both is the final key to a successful investment strategy, to mastering your asset allocation, and to building the kind of wealth that leads to true financial independence. You have made it through a deep and rigorous exploration. You have invested your time and your attention, and in doing so, you have acquired a powerful mental tool. You now possess the ROE compass, a way of thinking that allows you to cut through the noise of the market and instantly filter the vast majority of mediocre businesses, focusing your precious time and capital only on the true, high-quality wealth creators. You understand that a high and sustained return on equity is not just a financial ratio. It is a sign of competent management, a powerful compounding engine, a durable economic moat, and the ultimate anchor for rational valuation. This one concept, fully internalized, can permanently change your financial future. But it's crucial to understand that what you've just mastered is a single, powerful node in a much larger network of thinking. The world's greatest investors, like Buffett, don't rely on a single model. They have a latticework of interconnected mental models that they use to see the world with more clarity. Knowing a company has a high ROE is the critical first step, but it raises other, deeper questions. How can you be certain that ROE is not being artificially inflated by excessive debt? How do you calculate, with more precision, the exact intrinsic value of that business to know the perfect price to pay? How do you analyze the quality of a company's cash flows to make sure the reported earnings are real? The framework you've learned today is like having the powerful engine of a race car. But you still need the chassis, the steering, and the brakes to win the race. The journey to becoming a truly sophisticated investor, a CEO of your own financial future, is a process of assembling that full vehicle, piece by piece. It's about building a complete mental arsenal. And the video that is now appearing on your screen is designed to be the next piece of that arsenal. It might be the very link that connects the quality of a business, which you now know how to identify, with the precise methods for valuing it. It could be the blueprint that shows you how to analyze a balance sheet to spot the hidden dangers of debt that can turn a high ROE company into a ticking time bomb. Think of it as the next piece of the map, the next component of the machine you are building. Most people will stop here, satisfied with this one powerful tool. They will feel they've learned enough. But for those of you who are truly serious, for those who are on the path to becoming a member of the intelligent investor minority, the journey doesn't end. It continues. That next step, that next piece of the mental lattice work, is waiting for you. The choice to continue your ascent is yours. Click and complete your arsenal.